So this will now bring us to the SWOT analysis portion of our presentation. So we will lead off with the strengths of HCA. The number one strength is their pure size. They operate over 160 hospitals, mostly in the United States and United Kingdom. That size and the number of hospitals they operate is a strength in itself. And also the United States and United Kingdom are two of the fastest growing healthcare sectors in the world. So that provides a major strength as well. They employ over 200,000 people. That's the most in the healthcare industry. And then they also have extensive training programs for their new employees, and then they have a bunch of management programs to help their management team be one of the most efficient ones in the healthcare industry as well. They're also a front runner in technological advancements and innovations for the healthcare industry. That has been one of the main strengths that has provided them with their long-term revenue. So while they have a lot of strengths, they also have a lot of weaknesses on their back. The number one weakness is that they are so innovative, as I said on their strengths section as well. So because of their innovation, because of their innovative mindset, they occur some major losses at times from investments in equipment or processes that prove to not be profitable for their company. They may invest millions into equipment or a new service that they offer, and it brings no additional revenue to the business. They also need expansion in the number of products and services that they offer for their consumers. They're right on about industry average with most of the other companies, but with a company as large as HCA, you would expect them to be above the industry average in a sector such as that. They also have a difficulty adapting to cultures after mergers and acquisitions, so they have a lot of employees that are coming to join their business after HCA acquires another company or merges with another company. They're always at major risk for a lawsuit due to malpractice. That's not something that is unique for HCA. That's something that a lot of healthcare companies are always at risk of. And then lack of expansion is their number one weakness. Like I said, they only operate in the United States and United Kingdom, so they're missing out on a large market like in other places of the world. And that brings us to the opportunities, where the biggest weakness is also the biggest opportunity, which is expansion. If they were able to expand into more countries, they'll be able to increase their revenue, increase their consumer market, and increase their market share. They should also focus on integrating some new specialized hospitals or healthcare centers. There's been a lot of competitors in their industry that have been establishing these specialized hospitals, and their market share has grown as a result of that, and that has become a major threat to HCA. They should also try to incorporate a better online presence. It's just the way the world works today, where most people would rather do things online than have a face-to-face conversation or face-to-face interaction with somebody. They should also increase their marketing to higher income areas, with the economy starting to shape up and starting to go on a nice incline. Increasing their marketing to higher income areas to be able to increase their consumer base. And then also develop new products and services that will satisfy some recent consumer trends that we're seeing in the healthcare industry. Threats to their operations. Number one threat to any healthcare company right now is any change in government policy or regulation that could be coming. There's been a ton of changes to government policies for healthcare that have been proposed but haven't been acted on, that would increase the costs that it would take to run one of these companies, which in turn would increase the cost that they would have to charge to their consumers. It could also be difficult for HCA to expand in their current markets that they operate in due to the diminishing workforce they have right now. With so many people entering the industry, so many companies entering the industry, the people that are going for these jobs are just getting swallowed up. And especially with the standards that HCA holds, it's going to be harder for them to find employees to work for them. They're also too focused on the physical supply chain and the physical control of their raw materials. They're not focused enough on an e-commerce or a online aspect of healthcare. If they were to choose to expand, there would be extensive culture training that would need to be put in place for all their employees, just because cultures are so much different, especially in the way that they take care of people and health in other countries. And then the price of raw materials overall for the healthcare industry is on an upward slope, making it more expensive for healthcare companies to operate. For a financial analysis, HCA's revenue has been growing steadily between 5 and 8% over the last 4 years. For the financials, we looked at ratios such as return on assets, return on equity, gross profit margin, operating profit margin, net profit margin, and return on invested capital versus the industry averages. Return on assets is better than industry average. It was steadily increasing over the first 3 years we analyzed, and then it had a slight dip in the fourth year. That dip in the fourth year wasn't due to a decrease in revenue, but rather to a increase in the SG&A expenses in relation to the growth percentage of the revenue. The return on equity is a very strange financial ratio for HCA. It's kind of a head scratcher for any analyst for any other industry except for the healthcare industry, pretty much. Return on equity is way in the negative for HCA. It's due to the high levels of debt that they operate with, and the debt is as a result of millions and billions of dollars that they've given out to shareholders in years where their income was dwarfed by the amount that they returned for their shareholders. The gross profit margin was a little bit better than the industry average. Just like most of the other ratios that we analyzed, it was a little bit of a dip in the fourth year. The operating profit margin and the net profit margin kind of followed the same suit. There was this slower revenue growth and then a higher increase in the SGA in the last year. The net profit margin actually dropped so much that it was about the same number that was reported in 2014. So it kind of set them back almost 3 years. It's kind of set back the progress that they had over the last 3 years. And then the return on invested capital is the most impressive financial analysis ratio that HCA holds. It kind of follows the same trend as the industry. The HCA pretty much is the one standout company as far as this ratio goes for the healthcare companies. It also experienced a slight decrease in the last year. It's not really anything to be concerned with overall. It's likely just due to investment in new equipment and new processes as a result of the healthcare industry changing over the years. So some strategic concerns that we came up with after analyzing HCA. They have a strong emphasis on the medical personnel and not really as much on the equipment and the processes they operate with. So if they put the same amount of focus and attention to the equipment and then their processes as they do that are actual employees, that would optimize their efficiency. Increasing levels of debt, as I mentioned with the return on equity, kind of just brings up some red flags about future growth for stockholders and shareholders. The competitors are growing at a faster rate than HCA is right now, mainly due to the specialized hospitals. There was a nice decrease in the return on assets and return on invested capital. It's not really anything to be alarmed at right now, but if it was a trend, it would be a huge red flag to any investors in the future. And then competitors are beginning to make a more reputable name for themselves as compared to HCA. They've become more of a brand name, so kind of stealing a little bit of the brand loyalty that HCA has. That's HCA's largest strength, so that's a huge concern for the company. So some recommendations on those concerns. The first one to be innovate the existing profitable facilities and equipment that they have. So better products, better services would lead to a larger consumer base, and we get that revenue ramped back up to a level that it was before or even better. They should also consider liquidating some of their unprofitable assets. That would increase those return on assets and return on invested capital ratios, look better for investors. They obviously have a lot if their return on assets and return on invested capital dipped that much over this past year. And then they should also consider following suit with a lot of the other companies in the healthcare industry and try to implement some of these specialized centers. There's been a lot of focus on heart health and things of that nature. So developing some hospitals or some medical centers that are focused mainly around cardiac health would be a huge strategy movement for HCA. Be able to bring in a whole lot more profit for their industry as well. So these are some of the strategic recommendations and concerns that we offered for HCA, and if we believe that if they would act on these recommendations, that it would increase their profit long term. And even though their decrease over the last year was just a slight one, it would get them moving in the right track and probably get their revenues moving at a level that was even higher than what they had before. Thank you.